Good afternoon. Welcome, everyone. Welcome to the CUHK Law, CCTL Corporate Law and Governance class lecture on dual class structure in the age of unicorns going public. What has been discussed and what have we known? Now, today is my distinguished honor to introduce our speaker today, Professor Wei Zhang. Now, Professor Zhang is Associate Dean of SMU Law School. He has received education from multiple jurisdictions, including Fudan University in mainland China, and Waseda University in Japan, Harvard Law School, and UC Berkeley in the United States. His area of research include empirical legal studies, corporate and securities law, law and economics, Chinese law, and property law. Now, he has published widely in leading international peer-reviewed journals. Now, without further ado, let me just pass it on to you, Wei, Professor Zhang. Over to you.
Thank you. Thank you very much, Professor Xitao. It's my great pleasure and honor to have this opportunity to to exchange the ideas with my colleagues in CUHK online, in particular about today's topic, that is the dual class structure listing. So I have some slides to share. So let me see if I can just share this PPT with you. Okay. So can everyone see my slides here?
It works quite well, I think, yes.
Okay, thank you very much. Let me try to make a slideshow from the start, okay. Okay, thank you very much. So my topic today is about the dual class structure. I think it's by now, it's quite a familiar topic. So today's my discussion will not be strictly following a particular paper or study I am doing, although I will of course present to you some of the findings in my latest ongoing studies in this regard. However, I would say it's more like a kind of literature review or summary type of presentation about the current situation of the literature on this dual class structure listing. So let me just start by quickly summarize the essence of this dual class structure. I think by now it has been quite clear when we talk about dual class structure, we are not talking about the common shares versus preferred shares. We are talking about the double different voting rights allocated to the shareholders of common stocks. Right, so the essence of this dual class structure, as we all know, it's about the divergence between the cash flow rights and the voting rights among common shareholders. And the function of this dual class structure, I think it's also very clear. It is just to insulate those who have the super voting powers, usually those insiders, from the market competition for corporate control. So sometimes it's called a nuclear weapon for any takeover. Even more effective than, for instance, the poison pills. And some people, some scholars call it an extreme governance in the sense that basically it's, you're completely insulated from the market competition for corporate control. And if we look at the history, we all know that for many, many years, I think it's still so far in most jurisdictions, the one share, one vote is the norm. And therefore, for many years, the dual class structure is an anomaly, in particular, existing in the United States. And as we all know in history, actually, even in the US, it's just some stock exchanges will accept this dual class listing until relatively recently. But we see relatively recently, the trend is the dual class structure has been spreading very fast outside the US, and especially in this region, Asia Pacific region. We all know that Hong Kong changed the rules, Singapore changed the rules, also Shanghai and Shenzhen follow suit. I know the dual class shares are also allowed in Japan, for instance. I haven't confirmed this, but I heard that Malaysia, they also allow this, and maybe UK, even the UK is considering about pivoting towards that kind of in that direction. So it's very, very influential as a matter in practice nowadays. So here is a little bit more about the U.S. The history about the the dual class shares in the United States. And we see actually it ebbs and flows even in the United States before the the Great Depression, especially in the 20s and 30s. There seems to be a lot of dual class companies went public during that period of time, but things changed dramatically after the Great Depression. As you can see, the number shows there are very few dual class companies went public between the 40s and the late 1970s. But again, things changed because of the 1980s. This is the age for hostile takeovers, right? So the dual class came back again, I think understandably as an anti-takeover device. But more recently, we see a lot of dual class IPOs as well. You see the numbers here, like 7% of the new IPOs in 2015, but recent years it seems to be more on average. But I think when we look back at this history, the year 2004 is definitely a pivotal, I call it a watershed year. That is because in that year, we all know that Google went public. Why it is watershed? Because the DCS, the dual class structure before 2004, what are those firms? Usually those are media firms, New York Times, Washington Post, all those are the firms that's using the names of individuals, those founders, those most influential individuals, such as Ralph Lauren, we all know it's a fashion designer, Martha Stewart, who was called super housewife in the US, right? So these are the firms before 2004. We see who will usually use the dual class structure, but after 2004, after Google went public, things changed dramatically. So after this 2004, almost all the high-tech companies in the US went public with the dual class structure, except a few exceptions, as you can see here. Twitter, most famously Twitter, Uber, Tesla, these companies. And in particular, we see the dual class structure in US, increases in number of those, big companies. So it used to be, if you look at the S&P 500 companies, there's only like 5% of dual class shares, but the number, the percentage doubled in the past few years. And thirdly, we see the appearance of some very extreme type of dual class structures. The most extreme case would be the zero voting shares, because we know the scholars call dual class shares itself an extreme governance. So I call it the extreme of the extreme. That's the zero, completely no voting rights for the public shareholders, as we see in the Snap case. And of course, we all know there is a very strong backlash from this, especially institutional investors. So there are exclusions from those indexes of those dual structure shares. This is like a brief history. I don't think I want to say too much about that. Then let's just look at briefly the theory. So I frame it as like the what have been discussed. So in this part, I mainly want to just go over some of the the major theories having been there for some time, about this DCS. So we know there are pros and cons for this DCS. The objections basically is that there's going to be the misalignment of incentives. This is a prototype of agency problem. It will disabling a very effective governance, mechanism that is to, governance by the market force. I think this is quite clear to us. Whereas those advocates for the DCS will say, oh, this is a way to ensure the management independence from so-called shareholder short-termism. I think the short-termism becomes a very big thing in recent years, right? In the literature, and it is a way also to overcome the shareholder apathy and the shareholders' lack of information, because basically those public holders, they will not vote. Even if you give them the voting rights, they don't know how to vote. They don't want to vote. So why not just give them voting rights anyway? So right, these are the those theories or points made by the advocates of this dual class structure. And in recent years, especially people in the literature, the scholars found that the DCS probably is especially good for young firms. That is probably because, I mean, these are theoretical arguments. Why it's especially good for young firms? Because the young firms, maybe there's greater information asymmetry between the insiders and outsiders, right? So I mean, so this apathy or lack of information phenomenon will be more, important or critical in those firms. And for those young firms, we see the founders usually they are more important to playing a bigger role, so that the market competition force actually is not that important in terms of to replace the founders to run in any kind of agency cost problems. And the founders are more likely for those young firms. They try to demonstrate their ability, right? They want to pursue the public benefit for the shareholders instead of pursuing private interests for themselves, because they want to just prove to the market they are capable entrepreneurs. Right? So for these various reasons, the theory goes that for young firms, the DCS structure is especially probably beneficial. Then there's also certain kind of I think it's all very popular kind of perception or argument that the dual class structure actually will not harm the public investor as long as it's adopted at the very beginning of the IPO, at the very beginning of the IPO stage, because the IPO price, when the public investors market sees that you have this DCS, then the public market basically is so efficient that it will discount in its IPO price for whatever negative effect that DCS may embody in future, right? So this is, I think, also a very familiar argument. But the problem here, as I see it, is this argument seems to be self-contradictory. The reason is, if you want to say the IPO price already, embodied whatever negative effect in future, long, away from now, from the IPO price, actually you are arguing that the public market is very far-sighted instead of short-termism. But the very reason, as I said, why the DCS is useful is because of the short-termism. So I don't know, when people saying that IPO, if you do this at IPO, everything is fine because the public investors will not be hurt. I don't know when you're making this kind of arguments, what kind of behavioral assumptions you are making about the public investors. In other words, do you think the public investors, they are short-termed or long-term? This is my question. I don't understand, honestly. So apart from those kind of general theories going out about the DCS, we all know there are. We also know there's some discussions about sunsets in recent years, right? The theory, again, there are pros and cons. Those who advocate, especially Professor Babchuk, very strongly advocate for the sunset, will say, well, this will bring the power back to the shareholders and avoid perpetuating the divergence in the economic and voting rights. And this is especially important after the shareholders, the super voting shareholders, reach their old age or become mentally incapacitated. I think one high-profile example Professor Babchuk and others used in this regard is the Viacom case, right? We know the founder of Viacom, Sumner Resto. I think he became, really, something mentally incapacitated because of his old age, or a lot of bad things happened to that company. So for those who against the sunsets, I think in particular, the two type of kind of arguments against the sunsets. One is, I think it's so if you want to mandate, especially a time-based sunset, for instance, the proposal made by CII, the Council of Institutional Investors, like after 7 years, you have to sunset, right? That kind of proposal seems to be a one-size-fit-all approach. But we all know that, especially in the capital markets, in corporate governance, usually the one size will not fit all. Right? This is a very famously kind of argument made by Professor Fish and Solomon in one of their recent articles. And also, I think there are scholars who are saying if you set a time-based sunset, so at a certain point of time, a due class, the super voting power, stocks should terminate, then you are inviting the so-called end game problem. So the super voting shareholders tend to play opportunistically when it comes close to the time of sunset. I think this most famously is put forward by Professor Coffey. My kind of response to these kind of objections to the sunset, especially time-based sunset, theoretically, I would say the first objection, I don't see it's a very powerful objection after all, because it's just a convenient critique. You can always criticize by saying, oh, if you adopt certain kind of uniform the rules, it's against this one size won't fit all kind of philosophy. I think, well, maybe in philosophically it's right, but I would say there are plenty of one size have to fit all cases in corporate law, securities law. We all know, for instance, we have this general the mandatory bid rule, right? For instance, the mandatory bid, why every company should comply with 30%, not let it just choose their own numbers. We all know this. And even if we look at the regulations, the prevailing regulations about the DCS itself, we use, of course, the golden rule. Every company, if you want to adopt DCS, you have to do it in IPO. This is, again, a one-size-fits-all rule. Why those are not problems? So I think the one-size-won't-fit-all critique probably it needs to have more substance instead of just claim, oh, one size won't fit all, so you should not have a time-based sunset. In terms of this endgame problem, I think the problem here is, the super voting power shareholders, they can always play opportunistic. Even if we don't set a sunset, as long as they think they are no longer interested in the long-term value of the company, they can just latently, secretly pick at any point by themselves, just not close to the public investor. Then they do things opportunistically, right? So if the opportunism is really the problem here, I think the problem is not to give. I think the solution is not to give those shareholders that much power in the first place, instead of arguing against having this kind of sunset, term-based sunset. And especially if we think, I think CII's proposal also include this. I think also Babchak supports this idea. You can, after certain amount of years, you can let the the common shareholders, public shareholders, to vote, right? To vote whether you can continue the super voting power in that kind of setting. Again, you bring back this a multi-stage game dynamic. So I think that could be another solution to the so-called end game problem. Again, I think another theory about the sunset, again, here is a theory, is that Professor Babchak and his co-author noted that this is, in particular, the time-based sunset is unlikely to be adopted voluntarily. This is a theoretical argument. The reason is mainly this time-based sunset is a public good. It's a public good. So to the extent that this kind of sunset can curtail the agency problem, it's a benefit to all the shareholders. Whereas it's a concentrated cost to the super voting shareholders. Of course, that's very, very clear. So whenever you have this kind of public goods, everyone shares the benefits, but only a very relatively small number of people will bear the cost, and then we will see insufficient supply of that kind of thing. I think this is a purely, I think, theoretical argument, and I think it's not difficult to understand. So so far I talked about mostly the theory, so what we have discussed. Now let's look at the empirics. So what have we known? So I think first of all I would like to share with you a very broad, very intuitive pictures. So let's look at the high-tech companies and dual class structures, because we know the major kind of reason, the main reason why this is good is because it's good for high-tech companies. It will help the high-tech companies to develop the growth really good, right? I mean, really well and fast. What's the reality? At first glance, you look at this table. The table is a little bit, old, but I think probably not too many substantial changes from then. This was, from one of the papers I prepared previously. So on the left side, you see, the 10 largest public high-tech companies by revenue in the US. Out of the 10, only 2, if I'm not wrong, the Alphabet, which is essentially Google, and Facebook. These 2 are dual class, have dual class structures. And on the right-hand side, we see the 5 fastest growing public high-tech companies, again, in the US. We don't see many, actually. Again, there are only 2 are, the dual class, Facebook and Google again. So I think, at first glance, it seems maybe not necessarily the case that you have to have dual class for the high-tech companies to grow big or to grow fast. And now let's look at this as a second, again, very intuitive, a broad picture. This tells us the number of listed companies in US, in Hong Kong, and in Singapore, I think in the past, from 1980 to 2017. So what this means, because we know when, especially, the jurisdictions here in this Asia Pacific region, Hong Kong, Singapore, when they are, arguing for the adoption of the dual class, they say, oh, this is a good way to attract, more listed companies to list in our exchanges, right, stock exchanges. So let's look at whether, again, intuitively, that kind of arguments can be borne out by the data. It seems to me not necessarily, because we all know that in the US, the dual class structure regulation changed significantly and fundamentally in the year 1994. So let's look at 1994. After 1994, I think it's safe to say there can be more, opportunities for the companies in US when they go IPO. They go IPO with this dual class structures, because we all know what happened in that year, right? So that basically, there's the 3 stock exchanges, especially NYSE, wrote out this pro dual class listing, rules. But we don't see actually, on average, at least I can say that after 1994 in US, compared to Hong Kong and Singapore, I put the Hong Kong and Singapore here mainly as kind of, control group, right, so to speak. We don't see US, the number of listed companies goes up relative to Hong Kong and Singapore. Singapore, of course, is always like, low level, but Hong Kong goes very fast, right? But US goes down. So these are, kind of, intuitive, big picture. I will go to more details about more, kind of methodologically gathered kind of evidence in a moment. But here, let's see, come back a little bit to the question: who uses this dual class structure in terms of, the empirical evidence? So pre 2004, I think I have alluded to that. I don't need to, repeat. I think these type of companies, it's not apparent, why these companies choose to list, within the dual class. Sorry, we know why they choose to list in dual class, but it doesn't seem to be because of their concern of the shareholder short-termism. I mean, for the media companies, it has always been the argument for the media independence of the media. That's why you have this dual class structure. By the way, maybe some of you are familiar with the Singapore company law. Even before, the recent change of Singapore Company Act, has long been the, the rule in Singapore that the media companies can use the dual class structures. And for those like Martha Stewart, those kind of fancy named companies, they concerned about their own names, right? So they don't want their own names to be, have some stigmas on their own names. So they want to control the company. But that's nothing to do with that, not that much to do with the short-termism. But post 2004, they're more like, high-tech companies, especially recently in the cloud industry. We see a lot of those type of dual class companies. More generally, we see, I mean, these are based on the latest, I would say, mostly the latest kind of evidence. The non-US listed companies, in US. So I mean, those are basically foreign private issuers, right? Foreign private issuers in US, especially those from China. They like to use dual class structures. And if the founder of the company at the time of IPO still controls the vote, it controls the company, has the control of the company, the more likely to have a dual class. And as the founder have more, bargaining powers, they tend to have, dual class structures. I think these are quite intuitive, right? If the founders have more bargaining power, of course, they will bargain something good for themselves. And a slightly different perspective we find, this is actually based on the previous literature, but also confirmed by my own recent study. The dual class structure more likely to be used by firms that are advised by the Silicon Valley law firms. So at the stage of IPO. So the second question is, what determines the wedge between the economic and voting rights? So how big is wedge? One share 1 vote, one share 2 votes, or one share 10 votes, or 50 votes, right? So basically that's the question. So again, the recent study found that if the founder controls the IPO company at the stage of IPO, the wedge tends to be greater. And if the founder has more bargaining power, then the wedge tends to be greater. Again, I think this is quite intuitive, but anyway, it's found by the recent empirical studies. Now let's look at the second aspect about the empirics. So the firm value, I think this has always been the central, at the center of the stage about this DCS argument. So the earlier findings about DCS companies in terms of their firm values, I would say, before 1990s, I think it's pretty much messy. I can say probably there's no consistent conclusion can be drawn from those empirical studies, as you see, some of the studies are listed here. But from the 1990s to the early 2000s, in particular before the 2004, I think more specifically, usually the data ends at 2002. So these kind of studies, especially those published on the very top, the top 3 finance journals, right? Journal of Finance, Financial Economics, Review of Financial Studies, they tend to find negative firm value impacts of DCS. So we see these are, I think, the Gompers Ishii metric paper, as well as the Masulis Wang Xie paper. Those are the 2 most influential papers, on this topic, providing some empirical evidence in relation to the firm value. But they also find, of course, the more serious agency problems will be spotted in those DCS companies in terms of the CEO compensation, in terms of the value of CAPEX. So these are the typical, indicators of agency problems. The more recent studies that include the post 2004 sample, so include many of those high-tech companies, tend to find that the DCS actually are good in terms of firm value. They are doing better than the single class firms. However, this advantage exists only at the early stage of those IPO firms' life. So at the IPO stage, they have fair value about 9% compared to single class firms. But this value advantage disappears in about 6 to 9 years after the IPO. And it goes long, when it goes longer, even longer, some studies find actually they become negative. So that means the DCS companies, their firm value actually are lower than the single class companies after about 12 years after the IPO. So these are some of the, I think, more recent studies. And again, this is the third, I would say, the third aspect of the empirical evidence, which is not strictly, about the dual class shares per se, but it's about the underlying reason why we should support the DCS. That is about short-termism. I think there are a lot of short-termism literature there, right? I mean, so for instance, again, a very intuitive anecdotal evidence. There's an article in Economist which says, look at the Amazon stock price, 70%, 75% of the stock price is just nothing. If you look at it now, there's nothing to support it. It has to come, after 10 years. So in future, the revenue in future will support the current stock price for Amazon. So that seems to be advocating the idea that the public investors are very long-sighted instead of short-sighted. And the most, I think, influential studies in this regard were conducted in relation to the hedge funds shareholder activism. So most famously, we know a Prof paper looking at the short-term firm value impact, and the Babchuk, Prof, and Zhang paper looked at the long-term firm value. Basically, they don't find, strong evidence that, those kind of short-termisms arguments can be borne out. In terms of the IPO pricing, because I said I can't quite understand what exactly logic is about this IPO pricing, but let's look at the empirics. The empirics just showed us the DCS firms, they do suffer less IPO underpricing. So what does that mean? We all know actually underpricing, IPO underpricing is a big problem, right? A big cost to the IPO companies. So the DCS firms suffer less IPO underpricing. That means they leave less money on the table, or in other words, on the first day of trading, the public shareholders bid at a lower level, at a lower price for those companies' stocks. Well, this is found, very early actually by in the literature, and recently, our own studies also confirmed this. But on the other hand, this is something from our own study, recent study. The DCS firms, if you have sunsets, and especially if you have time-based sunsets, then those firms will suffer more IPO underpricing. That means there's going to be higher first-day return. So the public investor was bid higher for those firms compared to single-class firms. Although in general, the public investors will bid lower for the DCS companies. So what does that mean? What does that mean? How to interpret this? So of course, we need to understand why this underpricing comes up. I don't want to stick to a particular theory about this, but we can, roughly speaking, there are two reasons, right? One reason is the underwriters, they at the pricing stage, they just pricing single class firms and the dual class firms more or less similarly. But the markets, they have different perspective. They have different opinions about these two types of firms. If that is the reason why we see this difference in underpricing, then that's just points to the fact that the market actually discount. They does discount DCS firms, especially when they don't have the sunset. When they have the sunset, actually the markets think, oh, well, that's actually good companies, or maybe even better than the single class companies. So they bid higher price for it. But alternative theory would be, the markets evaluates these two companies actually, blindly, almost the same. But the pricing, the IPO pricing, there are some different mechanisms there. So if that is the case, it's not necessarily point to the public market investors, whether they are long-sighted or they're efficient or not. But these are just, I think, some interesting piece of evidence that's probably worth further exploring theoretically. So now I want to turn to the empirical evidence in particular about the sunsets. So first of all, the adoption of sunsets, remember, Professor Babchuk and his co-authors argued theoretically, they don't believe the time-based sunset in particular will be widely adopted voluntarily by the firms. And the empirics seems to support that argument. If we look at the overall DCS companies, there are about, I think the majority of the DCS companies will adopt some form of sunsets. Maybe here I can just add a few more words about what are those types of sunsets. Usually we see mainly three types of sunsets. One is time-based sunset. The other type is incapacity or death-based sunset. And the third is the transfer-based sunset. If super voting power shareholders transfer the stocks, they will lose the super voting powers. So the first type is for time-based. The second and third type sometimes is for like the event-based sunset, right? Based sunset. So overall, it's pretty high percentage of DCS firms will use some type of sunsets. But when it comes to time-based sunset in particular, as Babchuk said, he also actually provided some anecdotal, I think, evidence. But more systematic evidence, coming from the recent literature, including our own research, is, indeed, relatively low percentage of DCS companies will voluntarily adopt the time-based sunset. Then, what determines the usage of time-based sunset? Again, what was found is for those VC venture capital-backed IPOs, they're more likely to have a time-based sunset. So the theory is a little bit theory here. The theory is the VC investors, they're smart, they're sophisticated. So they want to put in the IPO, prospectus, the IPO governance structure, whatever they think will promote the market value of the firms. So if the VC-backed IPOs, they tend to more likely to use the time-based sunset, probably this again is a kind of by inference we can say it's seems to be a good thing, at least for the firm value. And again, our own research finds, the Silicon Valley law firms, those companies advised by the Silicon Valley law firms tend to use time-based sunset more frequently. In terms of the firm value, this is mainly from our recent, still ongoing research. We find that although the DCS firms seem to be better than the single class firms overall in terms of the firm value, that's because we expand the sample, not just as what's the Gompers or Masulis they did. Their sample ended pretty much in 2002. Now we incorporate the sample to much later time till 2019. So we find overall, yes, the DCS firm seems to be doing better in terms of the firm value than the single class companies. But we find when we divide the DCS companies into two groups, with or without the sunsets, we find actually the goods, whatever bad performance of the DCS company seems to be driven by the sunsets, especially the time-based and incapacity-based sunsets. If we look at the DCS company without these kind of sunsets, actually they are doing worse, just like what was found, by Gomper, Xi, and Masulis, Wang, and Xie. The positive effect of the time-based sunset on the firm value, I think, is in particular is especially large for the high-tech companies. So apart from the firm values, we also look at some, operational, performance, that type of indicators. It's, still not complete, but some of the indicators we looked at. For instance, we looked at operating margin. So that's the basically the profit made from a company's core business in relation to its revenues. Usually, it's considered as a measure of how well a company is managed. And we find the DCS firms with sunsets, and again with time-based sunsets in particular, showed higher operating margins. And we looked at innovative productivity, which basically means, we look at the patents with citations, scaled by the number of citations. So the DCS firms with sunsets, again, and time-based and capacity sunsets in particular, they achieve higher innovative productivity. So basically the citation scaled patent number becomes higher for those companies. We also look at the marginal value of the cash holding. So that's a measure for the value of investment opportunities and also for the management quality. So again, the DCS firms with the sunset achieve higher, sorry, I think there's a typo here. It's also achieve higher, the value, marginal value of cash holding. So as I said, we're continuing, to explore more kind of indicators, especially the operational indicators. But these are some preliminary results we found in our recent, still ongoing, work. So finally, I think a very quick, few words about the policy implications. First of all, we see, firms that are willing to adopt transfer-based sunsets, pretty high percentage, right? Almost 60% will adopt. I think mostly of those sunsets are transfer-based, but they are reluctant indeed, as Professor Babchak said, to adopt time-based sunsets. But we also know the fact that in those newly established DCS listing rules, the mandates only transfer-based and in some cases also incapacity-based sunsets. But to my knowledge, there's no listing rule currently mandates time-based sunsets. However, the empirical evidence seems to support the beneficial impact of the time-based sunsets. And in particular, I see that's probably the source where those various good things happen to the DCS companies. So the policy implication here seems to be, simple. It seems to me also it's clear. So the time-based sunsets should be mandated. So, but the question is, where should the line be drawn, right? So how many years of IPO should the sunset come? There are multiple studies. I'm citing other, Kim and McCady's study as well as our own study. It turns out to be the DCS companies tends to lose its advantage over the single class shares if we purely look at the firm value after about 6 to 7 years. Therefore, the CII's proposal about the 7-year time-based sunset seems to me probably it's worth some more consideration by the regulators. Okay, I think that's it for my presentation today. Thank you very much. And I'm looking forward to your questions and discussions. Thank you very much.
Thank you, Professor Zhang, for sharing your illuminating research. This is just a fantastic piece of study that you and your colleagues have carried out. Now, dual class shares, as you have elaborated, this is a very topical issue that obviously much ink has been spilled on, and I think your research has really bring a fresh angle to the current discourse. Thank you very much for bringing to us this very lively discussion of some of the most important current issues. Now, the floor is now open. As we are in a virtual setting, well, we wouldn't be able to invite everyone to just speak up. So what we do here is to invite those of you who are in the audience who have any questions or queries about Professor Zhang's lecture. Please send me a message, just text me, or if you like, you could text all, then I will be reading from your question. Now, there are a couple of questions which have been received. Let me just go by the sequence that they came in. Professor Zhang, this is a first question, which is, I think, which is really to ask a bit more information, really, about this comparative, very interesting comparative research you have done. So the question is this, which is, in the period discussed in your lecture, what exactly was the percentage of local and domestic companies from Hong Kong, Singapore, and other states around the world, and what percentage, what measurement of expansion of markets of independent states by multinational corporations in this period? I suppose the question is really about a breakdown of places of incorporation of these DCS companies.
Sorry, I unmuted myself. So Okay, let me just clarify. I didn't, explain the sample. So for those existing, papers, especially the Masulis, as well as the Gompers, and I think that also the more recent two studies about the life cycle, physical life cycle of the dual class company. Their sample, I'm not very sure because their studies, but in my to my knowledge, they're looking at the U.S. listed companies. Probably they are not. I don't think they're excluding, the for instance, incorporated in Cayman or many of those are Chinese companies actually, right, or in Hong Kong. But I don't know what's the percentage. I don't think they, maybe they reported, but I'm not familiar with what's the percentage of their data. In terms of our own data, we exclude all those kind of foreign issues, foreign private issues. So in our own sample, it only includes U.S. incorporated, U.S. listed companies. So that's our own sample. Their sample, I'm not very, I can't just say this off the top of my head without looking at their, paper.
Okay, thank you, Professor Zhang. That wouldn't be a surprise, I suppose. Well, the double class share regime has more recently been introduced in some of the Asian jurisdictions. I suppose the numbers wouldn't be too large. All right, the second question, I think, is a question about methodology, Professor Zhang. It's really about endogeneity question. I think this probably speaks to the one of the fundamental issues about any corporate governance research, which is the direction of causality. Well, it can always be said, I think corporate governance arrangement, including dual class shares, has implication for firm value. So perhaps how shall I put it, a superior, let's say, way of making a certain kind of a corporate governance arrangement can lead to a better firm value. But the direction of causality can also go the other way around, which is, firms with certain attributes, which is the firms which are inherently more efficient, may, well, for some reasons, for example, the high-tech companies may pick up certain corporate governance arrangements. So I guess the question is how your research has addressed this fundamental methodological challenge.
Right. Thank you very much. Of course, I think every paper, empirical paper now will be challenged on that kind of aspect. So again, for the Gomper-Shi paper, I think in particular, they have some way to address this endogeneity issue. If you read their paper, I'm not very, I don't remember what exactly, the Masulis Wang Xie paper used to address that question. But Gomper-Shi, they did something. Our own paper, of course, we did something to address this. But first of all, let me say this: these are all, like kind of, educated conjecture at most. I mean, we can always, put a pinch of salt on any of those kind of, methodologies tries to address this endogeneity issues. But with this kind of, caveat in mind, I would say, in particular, what we did is we used the IV, the instrumental variables. That is why probably, I don't know whether you feel a little bit weird why from time to time I said, the Silicon Valley law firms, they tend to, seems to be correlated with certain type of DCS structures. That is because actually we use the Silicon Valley law firms as one instrumental variable in our research. So the idea is, if you look at how the IPO lawyers, they can impact the firm values. I don't know. To me, it's not clear apart from, through their documentation at IPO stage, which of course, where the DCS comes up, right? The particular tailoring of DCS comes up. How can they affect, firm value through other channels? So that is, basically I think intuitively, the IV story is here. So, we see, on the one hand, the law firms, they have impact on the design of the DCS structure, and adoption of DCS structure. But on the other hand, this is, again, as I said, remember the caveat. I'm not trying to, defend and say, oh, it's perfect IV. I'm not saying that, but it's just, to a reasonable extent, I cannot think about other, channels where this law firm can affect the firm value. And also because we know the law firm picking, the IPO law firm picking, especially for those, I think especially in the high-tech industry, but I generally think that's true. They tend to find their IPO firms way early, not at the time of IPO. If you look at, for instance, again, the Google case, Google, I think initially, if I'm not wrong, like in year 1996. So their counsel has always been Wilson Sonsini since 1998. So at the time in 2004, it's IPO. So the argument I want to make is, again, an important element to support a valid IB a design that is the IB itself not picked, not chosen because of this IPO motivation. Because they started as a very young firm, they don't know where they go because there's a whole bunch of opportunities. They were burst, they were bankrupt, or they will be sold instead of going IPO. But at that stage, most of those firms, they already bound to certain kind of law firms. Usually, that's why the Silicon Valley law firms usually they just kind of grow with those companies as well. Also, I want to bring one more point in terms of that IB selection is. Maybe people say, okay, because those companies advised by Silicon Valley firms, they tend to be operating in Silicon Valley, right? So that's why they pick the Silicon Valley law firms in the first place. So what you see is actually not about the Silicon Valley law firms that will pick certain kind of DCS structure. It's just because the location of the IPO companies, the companies they situated in Silicon Valley, so they pick this type of DCS structure. So in order to address that kind of issue, we actually included the location where the firms are located. So even after controlling this kind of location effect, still the Silicon Valley company, the law firms, they're significant in terms of the design of the DCS structures. I think it cannot be explained as it's something because of location instead of because of the Silicon Valley companies. But again, I maybe just clarify a little bit. To be a valid instrumental variable, you don't have to say, oh, this thing is the only course of the DCS structure. You only need to have, this is something related and relevant to. There are certainly, there are other factors that determines the structure of this DCS, the design of DCS. I'm not saying Silicon Valley is the sole reason, but it does not have to be so. So I hope that somehow explained the question. Thank you very much.
Well, thank you, Professor Zhang, for this very sophisticated response. There's another question, which is, although DCS is more common amongst tech companies, is there an argument for companies in the financial sector, for example, banks, to consider such a structure?
This is a very good question. I have to admit, I know very little about the banking regulation, almost nothing about banking regulation. I don't know a lot about the specific features, attributes of the financial industry in general either. And I think maybe to your disappointment, disappointment, those empirical studies, including ours, they intentionally exclude financial companies because we know the financial companies have a whole bunch of different features, especially they're subject to very different set of regulatory frameworks. So probably that's the reason why they just exclude it. But yes, I think this can be a very different, it's different from the existing literature because in the existing literature, I don't see actually much discussion, if any, about the DCS effect in terms of the financial or banking industry. So I'm sorry, I don't have much to say except admit my ignorance in this regard.
Thank you, Professor Zhang. There's another one which reads, you have mentioned at the beginning of your lecture that there's a string of jurisdictions in recent years adopting DCS. Would you see them as raised to the top or raised to the bottom?
Well, That is hard to say. This is it seems to be a race. I think, especially in the case of Hong Kong and Singapore, they don't hide the intention is to race for more listings, right? I mean, that is a race. Whether it is to the top or to the bottom, it really depends on what the regulators are concerned about. If they do concern about the agency cause of problems and they understand to what extent this DCS will deteriorate the agency problem as compared to whatever the benefits the DCS may bring to the corporate governance. I mean, we have to admit, as I think that the data also shows, there are some probably benefits of this a DCS structure. If the focus is mainly about, just try to cater to the founders, in order to bring as many IPOs as possible, I would say to that extent, it's a race to the bottom, right? But if it's a well-calculated decision after a solid knowledge of these pros and cons, in particular those empirical evidence, and design the listing or regulations, accordingly, I think it can be also, a race to the top. I think we look at again back to the intuition. Without considering all those details of the empirical evidence, the intuition is clear. It is the United States that first championed this DCS. It is also probably, I think most people will agree, U.S. capital market is one of the most active, the deepest. So I think probably the big picture here seems to be the DCS. We cannot say it's just it's so bad. It's always bad. Right? So you say you adopt the DCS, it's a race to the bottom. But I think, again, for the regulators, you need to consider probably a little more instead of just looking at, whether it's just impact on the number of listing companies. And I show you in the in that three curves picture. I don't think this DCS will immediately have this impact of bringing more companies to list in your stock exchanges, because this kind of effect can only arise when other things are equal. So ceteris paribus. Here we see in different jurisdictions, in different stock exchanges located in different jurisdictions, subject to different set of rules, they have so many things that are so different in addition to with or without the dual class listing. So there's no wonder why, even after you change the rule of listing by allowing DCS, you won't see, a lot of, new listings coming to your market and vice versa. Thank you very much.
Thank you for this very interesting observation. I think we're going to be running out of time very soon, and there are a couple of questions waiting. Perhaps I can just ask one last question. And if there are any further questions, please feel free to, if you wouldn't mind, send the queries can be directed to Professor Zhang directly. Now, this is about a sunset, safeguards, I suppose, in general. So you have mentioned the use of sunset clauses as a safeguard. What are the other options? I guess this is really coming from the regulatory point of view, to protect minority shareholders against the potential fallout of DCS.
Thank you very much. By the way, Professor Xi, will we end by 2 or 1:30?
We can be very flexible.
Okay.
We can be very flexible here. Yeah.
I mean, I'm just, thinking, if we have a bit of time, I can.
Yeah, of course, we can carry on, but we can anytime between an hour or an hour and a half.
Sure.
Yeah.
Sure. So, what I want to say is, this is a very good question. The sunset, why the sunset becomes a focus, I think it's mainly because it's not something just talked about. It's something implemented. Although, I see, there are certain type of sunsets more frequently used, so they have these practices so that people can have data and can, do whatever empirical studies. But apart from the sunsets, there are certainly other, protective or measures considered. For instance, there's a breakthrough, right? The breakthrough rule, I think, discussed at least, or maybe adopted. I'm not very familiar with the EU law, but discussed or maybe even adopted by certain kind of EU jurisdictions. However, to the best of my knowledge, it's not so far implemented in practice. we see a case in Japan, in Tokyo Stock Exchange. There is a case, I forgot again which particular stock IPO that is, that the IPO company voluntarily adopted certain kind of the breakthrough rules. So basically, if you have like 3/4 of the common shareholders agree on the merger, proposal, then the super voting power will just be converted to one share, one vote. Those type of things. So those are also conceivably the protective, in the sense that it can overcome the agency problems to some extent. But the question is, how this is different, function-wise, with from the sunset, especially time-based sunset. And because of the very, very small sample, I think to my knowledge, there's only one in Japanese in Tokyo Stock Exchange. I don't know other examples. So this, of course, prevents a more like in-depth empirical study in that regard. So I don't know. Again, I have to admit, my ignorance in that regard. So generally, I would say today's topic, we have a lot of ignorance. We don't know a lot about it yet. But yeah, certainly there can be other ways to provide the protections in addition to the sunsets.
Well, thank you, Professor Zhang. My colleague has just reminded me, absolutely, well, we do have flexibility, so we can move ahead since there is another question coming from the audience. So Professor Zhang, if you don't mind, then we can put this question to you now. Which is, what do you think should be the best way to regulate due class recapitalization, i.e. midstream changes to control rights?
So I think now, if I'm not wrong, the prevailing rule, I call it the golden rule of due class, is you can only have due class at the stage of IPO. You cannot adopt due class through recapitalization. So again, this is a very interesting thing. If I believe some of my colleagues here will be familiar with the literature. That's, I think, initially coming from the Jeffrey Gordon's paper in the 1980s, if I'm not wrong. So why the U.S., in particular, they looked at this IPO stage. Literally, that's the only restriction, the United States they put there, right, in relation to the DCS listing. So that comes from an early experience of recapitalization using this DCS. So here comes down to a question why, because we know the recapitalization, you always need shareholder approval, right? So you need those, the public shareholders to approve this. So the question is why this kind of shareholder approval can remove any negative or any concerns about the agency problem here. So in Jeffrey Gordon's article, I think he detailed the particular practices implemented, exercised in the US at that time. They tend to bundle, in short, I think, again, I kind of vaguely remember only, the structure here, but in short, what they do is they combine this recapitalization proposal with something else, especially some sweeteners, so-called. So basically, if you agree on this recapitalization, you get some benefit. So with the, I would say, the enticing, sweeteners, the public shareholders somehow, well, you can say defrauded or like cheated or at least induced into vote yes. So that is the concern originally, I think in the US. That is why in 1994, when the major stock exchange in the US unified their listing rules, they particularly removed the possibility for companies to adopt a due class structure through recapitalization. That is, again, so that is why I'm saying the one size don't fit all, it's really not a good critique, because this golden rule, if we look at the background, the history, is very specific to that particular practice in the US. I don't know to what extent when Hong Kong and Singapore regulators, they adopt their new rules, also the Shanghai, Shenzhen Chinese regulators, they know the background there. if they know the background there, maybe that's may not have to be the golden rule either. We can have other ways to regulate. For instance, you cannot do the bundle. If the problem comes from the bundling, you cannot do the bundle. But anyway, we don't see any regulation so far, which allows recapitalization to adopt this DCS. Thank you.
Well, thank you, Professor Zhang, for again this very thought-provoking discussion. I think this is a very important piece of research that they are carrying out, and we all very much look forward to reading your paper when it becomes available. Now, as you mentioned just now, that you have all these Asian jurisdictions in the race, even though we're not sure which direction the race is going, encouraging the listing of DCS companies on their bourses. Perhaps in due course, when there's a critical mass of companies in this region using DCS, then perhaps you can also bring us with your insights on how DCS fare not only in American markets, but also in this part of the world.
Yeah, thank you. So actually, if I may, yes, we are actually doing another piece of research that's even earlier, more earlier stage. So we look at the Hong Kong market in particular, but of course, there's not many DCS companies in Hong Kong anyway, so we use some different, angles to try to explore it, but it's still a very early stage, so I don't have too much to say about that study.
That sounds great. In which case, we really, if you don't mind, we really would love to welcome you back and give another talk on DCS in Hong Kong. That would be fascinating. That would be extremely equally relevant to this audience in Hong Kong.